One should also understand some of the basic accounting terminologies that are also the important metrics to understand the company's financial health. Number one is revenue, which is the total amount generated by sales. It can be calculated by multiplying the average sales price by number of sales. Second is cost of goods sold. It includes all the cost that is involved in producing the goods. It may include raw material cost and labor cost. Gross profit is calculated by subtracting the cost of goods sold from revenue, while gross margin is nothing but the gross profit in terms of revenue percentage. Another important metric is operating profit or operating income. It is calculated by subtracting the operating expenses from the gross profit. Operating expenses may include any expense related to business operations. For example, rent, utilities, employee salaries or employee benefits, and insurance premium. However, it doesn't include interest paid on debt and company's taxes. And operating profit margin is nothing but the operating income in terms of revenue percentage. One important thing to note here, both gross margin and operating income have to be looked on to understand the company's financial health. Because a company can have high revenue as well as high gross margin but may have low operating income. It may be due to a lot of cash burn. So that's why both the metrics need to be compared to understand what's going on internally. Now if you look at the definition for assets are the resources which are controlled by the business. It could be of two types, tangible and intangible. Tangible assets are assets which are of physical in nature, for example machinery, physical items, vehicles, inventory and so on. While intangible assets are non-physical in nature, for example copyright, patents, brand identity and so on. Now all the assets, even as small as coffee vending machine, has been given value in the business balance sheet. Now liabilities for the company is the total value that the company must pay in short term or the long term. It could include loan, mortgage or rent payment and so on. It includes all the debts that company is having. Assets can also be divided on basis of liquidity, that is how easily it could be converted into cash. If it can be converted in cash within 1 year, they are called current assets. For example, cash or cash equivalent, stock inventory available for sale, or money invested in liquid fund, or any amount or money to be received in short term. All those are current assets. While long-term assets are fixed asset. For example, land, property, machinery, equipments. Similarly, current liabilities are the current portion of the long-term debt that has to be paid within the next 12 months. For example, a 10-year loan consists of 9-year long-term liability, while 1 year which has to be paid for the current year is the current liability. Similarly, wages or salaries to be paid to employees which has to be paid in the current year are also part of the current liability. Last, shareholder equity is the money that is attributed to the shareholders. It is also equivalent of net assets after liabilities have been deducted from the assets.